Welcome to The Explainer. Today, we're going to reverse engineer a truly fascinating financial machine. We're looking at Bridgewater bank shares and their second quarter 2026 earnings. To really wrap our heads around their financial health and their overall strategy, we're going to use an engine of growth framework. Think of a bank not just as a giant vault, but as a finely tuned engine where deposits are the fuel, loans are the drivetrain, and margins, well, those dictate your top speed. So let's jump right into this with a number that absolutely jumped off the page for me. 21%. That is the annualized growth in Bridgewater's net interest income for the quarter. Going back to our engine analogy, that's the top-line speed. It tells us right out of the gate that this machine isn't just cruising, it is accelerating significantly. Now, behind the physical facade of Bridgewater Bank lies a highly efficient strategic operation. It's really easy to look at a bank building and just see bricks and mortar. But today, we're looking past the exterior. We're going to dismantle this financial engine piece by piece to see exactly how they're generating that kind of speed in what is definitely a complex economic environment right now. Here's our roadmap for the breakdown. 1. Q2 earnings top-line highlights. 2. Expanding net interest margins. 3. Efficient operations and deposits. 4. Strategic profitable loan growth. And 5. Asset quality and shareholder value. All right, let's get right into part 1. Q2 earnings top-line highlights. Because let's face it, top-line speed is great, but it doesn't mean a whole lot if it doesn't actually translate to the bottom line. Here we see a diluted earnings per share of 45 cents. This bottom-line number is the ultimate proof that Bridgewater's growth engine isn't just burning fuel for the fun of it. It's efficiently converting that 21% revenue growth into actual, tangible profitability for its shareholders. And that brilliantly illustrates their core philosophy, an absolute emphasis on profitable growth. They aren't just out there chasing loan volume for the sake of getting bigger. Instead, they're selectively engineering their expansion so that every new asset added to the books contributes meaningfully to overall profitability.
Moving right along to Section 2, expanding net interest margins.
For those of us who might not live and breathe bank balance sheets every single day, let's quickly define net interest margin, or NIM. In simple terms, it's just the profit spread. It's the difference between the interest a bank earns on its loans and the interest it pays out to its depositors. Basically, a wider margin means you've got a much more efficient profit engine. And just look at this jump. In the first quarter of 2026, their NIM was 2.99%, and Q2, it expanded to 3.07%. That's an 8 basis point expansion in a single quarter. In the banking world, squeezing an extra 8 basis points of profit out of every dollar you handle is a huge win, and it's a major reason behind that massive revenue jump we talked about earlier. So, what is actually driving that margin expansion? Well, it's a two-part equation. On one side, their loan yields are rising, hitting 5.91% as their portfolio reprices higher. And on the flip side, deposit costs, the cost of their fuel, are stabilizing. By charging more for loans while keeping their funding costs relatively flat, the margin naturally widens out.
Which brings us to Section 3, efficient operations and deposits. Take a look at this efficiency ratio. Bridgewater is sitting at 53.0%. For some context, lower is always better here, and the peer median is 57%. This means Bridgewater is spending just 53 cents to generate every dollar of revenue. They are running a remarkably lean internal operation, which allows a whole lot more of that expanding interest margin to flow straight to the bottom line.
But here's a highly critical metric we need to watch, 101.8%. This is their loan-to-deposit ratio. While they successfully grew deposits by $41 million this quarter, having a ratio over 100% means they currently have more money loaned out than they have sitting in core deposits. So the takeaway here is this. Going forward, the pace at which they can gather new core deposits is going to act as the governor on this engine. It's going to dictate exactly how fast they can safely grow their loan book.
Let's look at that loan book in Section 4, Strategic Profitable Loan Growth.
Here is the breakdown of their $4.4 billion loan portfolio. The standout is clearly multifamily real estate, which makes up 38.2% of the total mix. Now, while elevated payoffs have been a major headwind in other banking sectors, Bridgewater is somehow plowing right through that. Their specific expertise and their heavy weighting in this multifamily segment actually pushed their overall loan growth up by an impressive $58 million in Q2 alone.
And if we zoom in on that multifamily bucket, there's a fascinating micro-narrative. Their deep expertise in affordable housing. They've been active in this space since 2008.
Listen, this is not easy lending. It has a very high barrier to entry, just due to the sheer complexity of the transactions. But because they know exactly how to navigate it, it acts as a highly lucrative engine for them. They mitigate the risk by partnering with experienced, large-scale developers, extending their reach so much that 33% of this portfolio is now outside their home state of Minnesota. Plus, as an added bonus, it serves as a really strong source for gathering those much-needed core deposits.
Finally, let's wrap up with Section 5, Asset Quality and Shareholder Value.
We always have to check the warning lights on the dashboard. This quarter, the non-performing assets to total assets ratio did bump up, moving from 0.22% to 0.40%. Whenever we evaluate a financial institution, it's absolutely vital to look at these metrics objectively to see exactly how well they're protecting the money they lend out.
But hey, context is everything, right? That statistical jump was definitely not a sign of systemic failure across their loan book. It was entirely driven by one single mixed-use multifamily property moving to non-accrual status. Meanwhile, their actual net charge-offs, the money they've truly lost, dropped to an incredibly low annualized rate of just 0.04%. So the safety systems, it appears, are holding up really well.
So, with a safe, efficient engine generating all this profit, what do they actually do with the cash? Here is their exact playbook for capital allocation. Priority number 1, fueling organic growth. Number 2, share repurchases, and they actually bought back over 38,000 shares this past quarter. Number 3, looking for strategic mergers and acquisitions. And lastly, dividends, which they historically tend to skip in favor of just reinvesting directly back into that organic growth engine.
Ultimately, the whole shebang rolls up to this core focus, creating shareholder value. By carefully managing and expanding net interest margin, running a highly efficient internal operation, and selectively growing their loan portfolio in specialized niches like affordable housing, Bridgewater is actively building tangible book value in what is, objectively speaking, a pretty tough banking environment right now.
Which leaves us with this final thought for the day. We've seen the blueprint of this financial machine, but as macroeconomic conditions continue to shift, and as the fierce competition for those crucial core deposits really intensifies, how will Bridgewater balance the demands of its aggressive loan growth engine against the absolute necessity of maintaining strict asset quality? It's the ultimate test of their model, and definitely a key question we need to keep in mind as we watch this space. Thanks so much for joining me on The Explainer today, and keep learning.